So let's talk a little bit about the panel you were on this morning. You were also joined by the CEO of Moody's, one of the largest bond insurers in the world, and a company which defines itself by risk management, but one that critics have pointed to as failing to raise any red flags at the beginning of the mortgage mess. Well, what are your thoughts on rating agencies in general and where they stand in the mortgage mess?
Hi, and thank you for having me. The panel today covered a lot of interesting areas, but I think that sort of the most interesting thing was that people were focused on governance and the motivations of the managers of these large institutions. And so I thought it was just an interesting aside. To your question on the rating agencies, is I think that the rating agencies have to be de-emphasized, and I think that Frank Dodd does takes important step in taking rating agencies' ratings out of the regulatory capital calculations, and that will have a large impact over time. It's appropriate, and the summary is that the world became too dependent on what a few select groups of people thought the risks were, and in retrospect, it's fairly obvious that that was a bad setup.
Sean, your firm specializes specifically in risk management, and you have a big focus on mortgage-backed securities. In your opinion, what's gone wrong, what went wrong, and what has changed since?
Well,
how do we prevent another mortgage mess?
Not yet, but the mortgage market is still closed. So you have to think about which portion of the mortgage mess have we prevented another scenario of losing money for investors? I would say yes, because we've removed the risk from the investment community and placed it all on the government's balance sheet. Have we removed the risk that too much capital flows into housing because capital is underpriced? No, we've compounded that risk. We've compounded the risk that our resources as a nation become focused on a non-productive asset like housing, and we have to correct this. We have to let capital flow to places that it's the most rewarded over time, not the most politically convenient location.
Okay, and to that point, with this additional potential regulation, as we talk about risk management and banks get leery of actually exposing themselves to too much risk, what does it ultimately mean for banking customers?
Well, I think that, the banks have many customers. They have their depositors, which really are to a certain extent suffering from the quantitative easing and the lack of return on investments, and their customers in the mortgage department are sort of in limbo because they're not clear as to what the resolution is going to be for loans that are unaffordable. So I think for bank investors, it's an interesting opportunity for the bank investors and for the leadership of the banks to step up and to gain a little more credibility by providing more clarity on what their losses are in these real estate related markets. People lost money in the real estate related investments. That's fine. I think that what we focus on today in the panel was that let's go ahead and get some transparency over what those losses are, how well capitalized are these institutions post the mark-to-market on this real estate debacle, and let's move forward.
All right, Sean Dobson, thanks so much for joining us from the Buttonwood Gathering, Chairman and Chief Executive of Amherst Securities Group. Thanks so much, Sean.